As the Greek government continues to butt heads with its creditors, Athens is slowly running out of money, and a Grexit or Grexident seems increasingly unavoidable. With us in the studio to discuss the likelihood of such an event is Eran Peleg, Chief Investment Officer of Clarity Capital. Mr. Peleg, thanks for joining us.
Hi, pleasure to be here.
So what are the chances we see a Greek exit happening?
Well, I still believe that it's more likely that they stay in rather than leave. I think both European countries and the IMF prefer that they stay in, and both Greek itself prefers to stay in. European countries, I think, first of all, I think they appreciate many of the economic adjustments that have been made in Greece over recent years, many of which I think the kind of media or even investors have missed. And I think they appreciate that, and they will look to accommodate them.
Of course, that was under the previous regime. We're talking about a new regime here under Syriza, which has very blatantly said, we serve our people first, and you guys, your creditors, you come later.
Yeah, so I think a compromise will be reached at the end, and we see in recent days. I mean, I think that was even stated quite clearly by the Greek Prime Minister as well.
Well, they keep on saying that, but we'll actually see what happens, right? And ultimately, would Greece leaving the eurozone be such a bad thing?
So I think not necessarily. I mean, it definitely would be very difficult for Greeks initially, and if they default, if they leave the eurozone. But even from the Greek perspective, from a medium and longer term perspective, leaving the eurozone would enable them to regain their competitiveness much more quickly by establishing a new, much devalued currency, which would help them export, obviously cheaply.
Again, presuming that they'll actually take the necessary steps in order to get their economy in shape.
Yeah, but I mean, to some extent, being out of the eurozone will make them, give them more flexibility in some respects to make adjustments and gain competitiveness quickly. On the European side as well, I think if Greek does leave, it will reaffirm the notion that if you're in, you have to play by the rules. And B, I mean, obviously Greek has been kind of an uncertainty factor hanging over the eurozone for a couple of years now. If that is removed, that can also have a positive impact on the rest of the eurozone, perhaps.
Now, regardless of the economic perspective, I mean, it would be a shock to financial markets, wouldn't it?
So I don't think so at this point. I mean,
it's expected. It's sort of priced into the market.
Well, this is the thing. I mean, exactly. I mean, we see that, for example, recent polls amongst investors have shown that people now expect, or at least the possibility of a Greek exit with much higher probability than before. We see it when looking at asset prices. The Greek government bond, 10-year government bond, is trading at 11-12% yield, as opposed to Italy and Spain, which trade at 1.5%, 2%. So clearly, the market is differentiating between and saying there is a clear possibility that this will happen. So if it will happen, it won't be such a shock. Usually the risks that have a potential for us to impact markets significantly are the ones which are not foreseen, not the ones that everyone is aware of already.
Where, for example, there could be a contagion maybe happening to other countries, but that's for another time. Eran Peleg, Chief Investment Officer of Clarity Capital, thanks for joining us. Thank you.